It was a short ride this morning, and it was fun to sleep in a little bit. It's a pleasure to be here today. Obviously, we care a lot about the banking industry and the health of the banking industry, and some of the remarks I heard earlier are good news. The fact that you're open for business and available to lend. We're obviously looking for that in 2012 because we certainly want to see the economy continue to improve. It's obviously a pleasure to be here today to speak at this annual meeting of the New Jersey Bankers Association. In a recent speech, I talked about a number of the challenges facing the economy as we seek to secure the recovery and build for the future. Today, I'm going to focus on one of these. That is the problems in the U.S. Housing market. In focusing today on housing, I would emphasize this is only one factor behind the frustratingly slow economic recovery. Nevertheless, I think it's an important one that deserves our attention. As always, what I have to say today reflects my own views and not necessarily those of the Federal Open Market Committee or the Federal Reserve System. Now, the New York Fed is deeply committed to contributing to efforts to resolve the housing crisis that still afflicts our nation. Our economists monitor the housing market and analyze its impact on the national economy. My outreach staff works with community groups and housing practitioners to support local programs that aid distressed homeowners. Our lawyers perform pro bono work for homeowners facing foreclosure, and they advise on legal reforms, while our researchers and market analysts have developed proposals to mitigate current problems and improve the future structure of housing finance. In my presentation today, I'll explain why a more robust housing market matters for the wider economy. I'll also highlight those factors specific to housing that create a risk that it will linger in an extremely weak state for longer than is necessary and remain vulnerable to further weakness. I'll make the case for further housing-related policy interventions that would help stabilize housing prices, improve the housing outlook, and generate an earlier recovery in housing activity. I believe such actions would support growth and make monetary policy more effective in promoting the dual mandate given to the Federal Reserve by Congress, that is, maximum sustainable employment in the context of price stability. Now, given the excesses of the housing boom that took place in the early to the mid part of the last decade, a substantial downward adjustment in housing was unavoidable. Since peaking in the second quarter of 2006, home prices have fallen by about 30%, returning to levels that last prevailed in the middle of 2003. In the states of Arizona, California, Florida, and Nevada, where home prices rose much more than the national average, we've seen either bigger declines, with prices declining by roughly 40% on average. Over the past year, home prices have declined another 4%, though they remain roughly flat when one excludes distressed sales. Home construction has also collapsed, with new single-family starts falling from a peak rate of about 1.75 million starts per year to a low of 360,000 early in 2009. After that, we've seen a slight pickup, but housing starts are still bumping along at a very, very low level of about 425,000 at an annual rate. Although the number of mortgages becoming delinquent is off its peak, it remains very elevated, and in fact it increased a bit in the third quarter of 2011. According to the Mortgage Bankers Association of America, at the end of the quarter there were roughly 105 million first mortgages that were 90 days or more past due, and 2 million first mortgages in some stage of the foreclosure process. Now, over time, without an improvement in housing and the labor market, more loans will become seriously delinquent. Moreover, absent more aggressive efforts to find economically efficient alternatives to foreclosure, loans already seriously delinquent and in foreclosure will become real estate owned by the lender, or what we refer to as REO. My staff estimates that the flow of properties into lender REO in 2012 and 2013 could be as high as 1.8 million each year. That's up from 1.1 million in 2011 and around 600,000 units going into REO in 2010. The overhang of properties in the foreclosure REO pipeline continues to exert downward pressure on house prices and on housing activity. Recent surveys by Macro Markets and Fannie Mae indicate that households in the aggregate expect negligible gains in home prices over the next few years, with many of these people expecting that prices will actually continue to decline. Now, the ongoing weakness in housing has made it more difficult to achieve a vigorous economic recovery. Housing has inhibited economic activity through a number of channels. First, the strong rebound in residential investment that typically powers economic recoveries following deep recessions has been absent. For example, 9 quarters following the ends of the recessions that we had in the mid-1970s and the early 1980s, residential investment had climbed by 65% and 55% respectively above the level that was reached at the low points. In contrast, during this cycle, there has been no rebound in residential investment. In fact, in the third quarter of 2011, residential investment was still somewhat below the level in the second quarter of 2009. Second, by eroding household wealth, the decline in housing prices has contributed to greater weakness in consumer spending. For many American households, the family home is by far the largest tangible asset. It's a buffer against misfortune, and it's often a significant savings vehicle that can be used to fund retirement. Since home values peaked in 2006, homeowners have lost more than half their home equity. That's more than $7 trillion, and expectations of future gains have also declined. At present, we have roughly 11 million households who are in a negative equity position. In other words, the value of their home is worth less than the value of their mortgage, with an aggregate amount of negative equity estimated to be at roughly $700 billion. Third, the weakness in home prices has reduced credit availability. Because the home is the primary source of collateral for most households, financial institutions are less willing to lend when house prices have declined substantially and could decline further. In addition, problems in the foreclosure process and obstacles to efficient modifications of loans and securitizations, which I'll discuss in a minute, make the house of a given value less attractive as collateral to secure a loan. As a result, as home prices have fallen, financial institutions have tightened lending standards. This has reduced the amount of credit available for households, including for small business formation. Fourth, the big drop in home prices has made it more difficult for borrowers to refinance. This has undercut, to a degree, the ability of monetary policy to stimulate the economy and support demand. Traditionally, refinancing activity has been an important channel through which lower interest rates support spending and employment. Refinancing frees up income for other uses because those who refinance tend to have a higher marginal propensity to consume from income than the investors receiving the mortgage payments. Such refinancing activity does increase overall demand. However, the fall in home equity combined with the pro-cyclical tightening of refinancing standards and fees means that many borrowers who would like to refinance cannot do so. By many measures, including affordability ratios and price-to-rent ratios, home prices have fallen back to or below their pre-boom levels. Indeed, housing no longer appears overvalued. In many former boom localities, in fact, the price of existing homes has fallen below the cost of building a new home. Also, after several years of depressed construction activity, the national stock of housing no longer looks excessive relative to the nation's population. Nevertheless, housing currently remains in excess supply, and that's in part because household formation rates have remained depressed. Now, normally when there's excess supply, markets self-correct fairly efficiently. Prices fall until they reach a level in which supply and demand are balanced. Unfortunately, the housing market has a number of specific features that complicate this adjustment process. And this means it could undershoot, in other words, remain weaker for longer than is absolutely necessary. Housing is a very long-lived asset. Once new building ceases in stressed markets, further reductions in demand cannot be matched by further supply reductions. This means that the market clearing price for housing is highly sensitive to those factors that influence demand. Moreover, there is a feedback loop from prices to demand, with weaker prices leading to weaker demand. If house prices are anticipated to increase, then the expected capital gain helps to offset the financing cost of owning a home. However, if households believe that the house prices could decline further, the expected capital loss adds to the expected financing costs of owning a home, and prospective buyers in those circumstances will be reluctant to buy even if mortgage rates are low. That said, it should also be recognized that the factors that affect demand and home prices are not immutable. They depend in part on the policy choices we make. Consider, for example, the fact that most home purchases are financed with long-term mortgage credit. This means that the demand for housing is highly sensitive to the availability and cost of this credit. Outcomes in housing are also affected by the legal and operational infrastructure of the mortgage market. This apparatus, as we've seen, has been wholly inadequate for dealing with a systemic shock to housing and employment, and this is amplifying the bad outcomes that we're seeing. A flawed resolution regime, very different from the more efficient regime we see for resolving excess debt in the private commercial property market, exacerbates the risk of undershooting. Conflicts of interest are embedded in mortgage securitization structures and between first and second mortgage lien holders. There are challenges to how the industry records and transfers interest in these mortgages. For mortgages that are part of securitizations, the legal obstacles to loan modification that preserve value are substantial. Meanwhile, mortgage servicers lack the systems, processes, governance, resources, and incentives to deal effectively with a large volume of delinquent borrowers who often suffer poor customer treatment at a time of personal distress. The result is inefficiently low levels of mortgage modification, too few short sales by mutual agreement between distressed borrowers and lenders, and too much reliance on the foreclosure process. This process also has many legal impediments, has become even more inefficient as the volume of loans in the pipeline has increased. One consequence has been lengthening delays in completing foreclosures, including unavoidable foreclosures. These delays have increased the economic damage caused by foreclosure, and they've reduced recovery rates. Now, the damage, I think, caused by inefficient foreclosures is worth emphasizing. It's not just the direct loss in terms of the deterioration of home values that are ultimately foreclosed. In addition, as I personally witnessed in my outreach visits across the New York Federal Reserve District, foreclosure imposes significant costs on families, surrounding neighborhoods, and communities. Unmaintained homes facing foreclosure drag down the value of nearby homes. Also, property taxes on non-foreclosed homes often go up due to a declining tax base, and this puts additional downward pressure on home prices. Foreclosures also undercut housing demand. Households that go through foreclosures and need to repair their credit records, and they have to accumulate new down payments. This means that for several years they're no longer available as potential home buyers, and this also contributes to weaker demand and softer home prices. Further declines in home prices also could be reinforcing because they would likely make the already daunting foreclosure REO pipeline even larger. Currently, households in negative equity or underwater on their mortgage loans owe about $65,000 on average more on their mortgages than the value of their homes. Since the recession, most defaults have been by necessity. That is, they have been prompted by job loss, health problems, or divorce, coupled with the household being in negative equity. No doubt, however, there is some degree or duration of negative equity that may cause households to conclude that a default is inevitable and should be taken sooner rather than later. If this point were reached, defaults by choice could significantly swell the flow of homes into the foreclosure pipeline. All these factors imply that there are many potential equilibrium outcomes in terms of housing demand and home prices, some considerably more desirable than others. Negative price expectations and flawed financing and administrative mechanisms, if left unaddressed, can contribute to ongoing weakness in housing demand and make it harder to generate a robust economic recovery. Persistent weakness in housing is particularly problematic because it acts as a drag on spending and job creation in an environment in which such weakness cannot be easily offset by other policy adjustments. Housing policy therefore should seek to break these adverse feedback loops to promote a more economically efficient outcome in housing and to support economic growth. In recent speeches, I've called for a comprehensive approach to stabilize the national real estate market and to lay the foundations for economic recovery. I believe this should include measures to improve access to mortgage credit, reduce obstacles to refinancing, to lessen the flow of homes into foreclosure through bridge financing and accelerated principal reduction, and to facilitate the absorption of real estate owned back into use as owner-occupied or rental housing. Now, many of these policies simply seek to solve or bypass the legal and incentive problems that we see in the market today and try to mimic efficient private actions that might be taken if mortgage loans were all held in portfolio and accounting rules did not discourage net present value maximization. Others seek to solve coordination problems and take account of the externalities and spillovers that generate outcomes that are more superior from the broadest perspective of the nation as a whole. Earlier this week, Chairman Bernanke sent members of Congress a thoughtful analysis of housing policy that was undertaken by the staff at the Board of Governors in Washington that evaluates a number of the same issues that I'm going to talk about today. What I'd like to do today is to elaborate on some specific proposals that we've developed in New York in order to try to persuade you that there are workable solutions to our housing problems at costs that I deem very reasonable relative to the economically inefficient path that we're on today. Of course, I'm open to other promising alternatives that would address these same issues. I note also that a truly comprehensive approach would also include long-term reforms, including reforms of Fannie Mae and Freddie Mac, to put housing finance on a more stable footing and to equip the market to deal more effectively with future systemic shocks. But we will not discuss this particular issue in depth today. Now, restoring demand for housing requires new mortgage debt to be offered to credit-worthy borrowers on reasonable terms. This is important because residential mortgage lending terms have tightened significantly during the crisis, and they have not eased subsequently. Indeed, 50% of all new loans and 70% of new prime-conforming loans go to borrowers with FICO scores of 760 or above. This compares to about 30% before the crisis. Borrowers with credit scores of 720 or less now make up less than 30% of new originations, even though they represent about 52% of the population who has credit scores. Steps should be taken to improve households' access to credit. Currently, lenders are discouraged from making new prime-conforming loans due to excessively stringent put-back rules on these mortgages. Such rules give Fannie Mae and Freddie Mac broad scope to force originators to repurchase at par loans that go delinquent if there are any errors in the mortgage loan paperwork, even if the error has no direct link to the delinquency. It's essential that lenders are accountable for the representations they make and are appropriately penalized for any misrepresentations. However, doing this via a blanket repurchase regime that leads to bad outcomes at a time when there's unusually high risk of job loss, which will lead to delinquency. It would be better to establish an alternative ways to penalize lenders for misrepresentations that were not in practice so closely tied to the risk of job loss. The current repurchase regime exposes lenders originating prime-conforming loans to significant credit risk and encourages them, therefore, to focus only on the lowest-risk customers. Lenders are applying tougher restrictions than Fannie Mae and Freddie Mac formally require in order to limit the risk that they will have to take back such loans when they become delinquent. For mortgages guaranteed by Fannie Mae and Freddie Mac, a better balance between incentives for sound underwriting and credit availability could be achieved by inserting a materiality test in the rep and warranty agreement. In the future, it would also be worth exploring whether a better regime in general would be to have representations and warranties with a finite duration, but supplemented by a rigorous quality control check of the underwriting based on a random sample of the mortgages that were being securitized. Today's tough underwriting standards and high risk-based premiums for conforming loan borrowers should also be reviewed. Now, in doing this, I don't want to see a return to the lax standards and underpricing of credit risk that we saw during the boom period. But the guarantees for new purchase mortgages should be based on the expected losses on these mortgages, not the realized losses on loans of earlier vintages. There's also a strong case for tackling the downward bias on appraisals, which are avoiding many transactions between willing buyers and willing sellers. Incentives for individual appraisers favor conservatism today, just as they favored over-optimism during the boom. This problem is aggravated by the difficulty in establishing benchmark prices in markets with few transactions and with a high share of distress sales. The industry could establish appraisal standards that could help avoid such pro-cyclical outcomes. Increased refinancing would support the housing market by promoting aggregate demand and employment. Refinancing creates additional cash flow for borrowers that will allow them to better able to absorb any adverse income shocks, and this reduces the likelihood of default, distressed sales, and future foreclosures. However, there are significant obstacles to refinancing in the current circumstances. Declines in home equity have been aggravated by tighter standards, high refinancing fees, burdensome administrative processes, and legal risks to the lenders that refinance the loans. Because the taxpayer by Fannie Mae and Freddie Mac is already exposed to the risk of conforming loans defaulting, it makes no sense to make it expensive or difficult for borrowers with these loans to refinance. After all, refinancing reduces the credit risk to which the taxpayers are exposed. It's also inefficient to fully re-underwrite applications for such refinancings. For example, appraisals could be greatly simplified and made less expensive by using automated valuation models. The Home Affordable Refinance Program, or HARP, was set up to facilitate refinancing of high loan-to-value prime conforming mortgages. The announced goal of the program was to refinance 3 to 4 million mortgages. However, shortcomings with the original program mean that less than 1 million HARP refinancings have actually taken place. Legal risk discouraged lenders from participating more fully in HARP to date. Notably, if a lender refinanced a loan made by another company, it was liable for the underwriting associated with the original loan. The profit, in this case, from refinancing was unattractive relative to the risk of being forced potentially to repurchase the loan. Given this, lenders had little incentive to compete to refinance loans, and this has led to higher mortgage rates and less financing activity. Now, many of these issues have been addressed by recent revisions to HARP and related decisions by Fannie Mae, but more could and should be done. Remaining legal issues could be alleviated by harmonizing standards between Fannie Mae and Freddie Mac. I would also like to see refinancing made broadly available on streamlined terms and with moderate fees to all prime conforming borrowers who are current on their payments. This could substantially increase the number of refinancings. To stabilize the housing market, we also need to weaken the link between unemployment and new foreclosures. The primary reason for distressed sales and mortgage defaults today is the loss of a job. Even if it were possible, it would be inefficient for homeowners with mortgages to self-insure against such job losses. Now, some support for unemployed homeowners has been provided in some states under what's called the Hardest Hit program. I favor a broad program to provide bridge financing for all qualified borrowers with the demonstrated ability to service their debts who become unemployed involuntarily, though categorically I would not include those who quit or are terminated with cause. If we did this in economic terms, we'd be offering collective insurance against job loss. My staff estimates that there's roughly 4 to 5 million at-risk households who can afford their mortgages but would struggle to make payments in the event that the primary earner in the household were to become unemployed. With the current weak labor market, my staff estimate that about 600,000 of these at-risk households will experience an involuntary job loss that lasts longer than a month over the next year. The average amount that would be required to keep the mortgage current for those households while they were unemployed and receiving unemployment insurance is around $21,000 per household. This would be a loan, not a grant. This implies, if we multiply the 21,000 times the 600,000, that we need an annual bridge lending program of about $15 billion a year to get us through the current stress period. Now, this seems expensive, but this is not the cost of such a program, just the cash outlay in the early years. In the future, loan repayments would help offset the program cost. Moreover, when one factors in the reduced negative externalities achieved by limiting distressed sales, the expected program costs would be considerably lower. Now, of course, any bridge financing loans would need to be properly secured in order to protect the taxpayers' interests. In situations in which the value of the loan already exceeded the value of the home, it might be appropriate to require lenders to write down the excess debt as a condition for the borrower obtaining the bridge loan. This would ensure that the bridging funds did not bail out the lender. In this case, writing down excess debt would likely be in the lender's rational self-interest, given that the borrower's situation of being unemployed and otherwise unable to pay on their mortgage, since a distressed sale or foreclosure at current market prices would generally result in larger losses. Investment firms that purchase delinquent mortgages routinely reduce principal in order to maximize the value on these loans. It would make sense for Fannie Mae and Freddie Mac to do this as well to minimize the loss of value on the delinquent loans they guarantee. However, I am uncomfortable with the notion that underwater borrowers who owe more on their mortgages than their homes are worth should have to go delinquent first before they have a chance of securing a reduction in their mortgage debt. I think we should also be developing a program for earned principal reduction for borrowers who are underwater but who are continuing to make their mortgage payments. Such a program would strengthen the incentives for mortgage holders who are underwater to continue to stay current on their loans, and this would reduce the likely number of defaults and ROE sales in the future. Negative equity is one of the most significant predictors of mortgage defaults. This is true if you look across a broad range of mortgage products, and it's true also when you control for credit quality and the level of income documentation. While recent underwater borrowers have not been defaulting at a rapid rate, they are also not prepaying. This implies that these underwater mortgages are going to remain at risk for a prolonged period of time, and that means that they're exposed for that period of time to any adverse shock to the borrower. Now, I would certainly admit it's challenging to predict precisely how these underwater borrowers will ultimately perform over time, and it's clear that this performance will be sensitive to the path of home prices. Nevertheless, the analysis undertaken by my staff that looks at likely borrower behavior over an extended time period suggests that without a significant turnaround in home prices and employment, a substantial portion of those loans that are deeply underwater will ultimately default, absent an earned principal reduction program. So one option developed by my staff is for Fannie Mae and Freddie Mac to give underwater borrowers on loans that they have guaranteed the right to pay off the loan at below par in the future under certain circumstances, including that the borrower has continued to make timely payments. For instance, the borrower could be given an open-ended option to pay off the loan at an LTV of 125% and the right to pay off the loan at an LTV of 95% after 3 years of timely payments. The borrower in this case would be protected against further declines in home prices, but in return would have to give up a portion of any upside from future capital gains on the home by a shared appreciation agreement. Note that under this arrangement, some of the reduction in the loan amount would actually be paid by the borrower as the outstanding balance was amortized by continued monthly payments. Now, even with an aggressive policies to minimize the flow of loans into foreclosure, my staff estimates that large volumes of properties, as I noted earlier, will still flow into lenders' REO over the next few years. This growing overhang could also continue to depress home prices. Thus, along with more incentives to promote short sales, steps should be taken to facilitate the timely and orderly absorption of these properties back into the market, including as renter-occupied housing. An interagency group, including the Federal Reserve, is working on issues related to REO to rental conversions. Appropriate policies would simultaneously lessen the downward pressure on home prices and the upward pressure that we're seeing on rents. Among other steps, investors could be encouraged to purchase REO to be made available as rental housing. Fannie Mae and Freddie Mac could increase the number of loans offered to individual investors, provided the investor puts up an adequate amount of equity for each mortgage. And the REO properties in a given locality could be bundled together for sale to make management of the properties more easily. The government might also consider a package of tax incentives for purchases of REO that are useful as rental properties. Such incentives might include a reduction in the current 27.5-year depreciation period and/or a reduction in the capital gains tax liability if the property is held for a minimum amount of time, such as, say, 5 years. One idea developed by my staff, let's call this idea as Homes for Heroes, would be to create a tax credit or other home purchase subsidy specifically for veterans of our foreign wars. This would enable these veterans to purchase such properties at a discount. There are over 2.5 million Gulf War II veterans alone, many of whom served multiple tours of duty overseas, and a significant portion of them otherwise might not be able to purchase homes today. Our nation, I think, owes these people a great debt, and such a policy would provide a boost to housing demand quickly. Now, some have argued that any interventions to support the real estate market would lead to moral hazard. That is, that these interventions would reward bad behaviors. I think these concerns are overstated. First, the programs that I propose can be designed with proper incentives to limit moral hazard and to discourage undesirable behavior. Second, in contrast to the earlier phase of the housing crisis, when it was mostly subprime borrowers that were coming under stress, many of the borrowers running into trouble today on their mortgages took out conforming mortgages subject to standard down payment requirements, had respectable FICO scores, and borrowed a moderate amount to finance an average home. The problem that they had with these purchases is the purchases occurred near the peak of market prices, and now many of these buyers have suffered an adverse life shock, such as unemployment or illness. In my mind, this isn't a moral hazard issue. This is just the bad luck associated with the timing of the purchase and an exceptionally weak jobs market. In my opinion, punishing such a misfortune accomplishes little. I believe that the proposals I put forward are strongly in the public interest. I also believe that they would be good for taxpayers. Consider, for example, the proposal for earned principal reduction. While this would certainly involve outlays, this would be offset by reduced defaults. Now, whether there's a net cost or not depends on the reduction in the default rate that would come about because of the principal reduction and how this reduction would affect the performance of the overall housing market and the economy. Based on recent data on borrower behavior, my staff calculates that the taxpayer, through the effect on Fannie Mae and Freddie Mac, would be better off with an earned principal reduction program under a base case of roughly flat home prices and persistent weakness in the job markets over the next couple of years. If we have a scenario of modest home price increases, the combination of fewer defaults and shared appreciation also produces a net benefit. And this net benefit calculation occurs even before taking into account the positive externalities of nudging home prices onto a stronger path, which would reduce the magnitude of losses on the loans that do default. On an expected value basis, such a program appears even more compelling since Fannie Mae and Freddie Mac are currently exposed to the downside risk of further declines in home prices. Of course, just focusing on the impact on Fannie Mae and Freddie Mac is much too narrow, even from a taxpayer perspective. If you believe, as I do, that improving the outlook for housing would materially strengthen our economy over time, one must also include the fiscal benefits generated by stronger economic growth. In closing, the housing agenda I described would address one factor that has impeded the economic recovery. Implementing such policies would improve the economic outlook and make monetary policy accommodation more effective. However, because the outlook for unemployment is still unacceptably high relative to our dual mandate and the outlook for inflation is generally benign, I believe it's also appropriate to continue to evaluate whether we could provide additional accommodation in a manner that produces more benefits than costs, regardless of whether action is taken on housing or not. Monetary policy and housing policy are much more complements than substitutes. As I hope I've convinced you today, while the Fed will do all it can to achieve our dual mandate of maximum sustainable employment in the context of price stability, we have to recognize that there's much more to economic policy than just monetary policy. Low interest rates help housing, but they cannot resolve the problems in a sector that are pressing on wider economic activity alone. With additional housing policy interventions, I believe we could achieve a better set of economic outcomes than with just monetary policy alone. I want to thank you today for your kind attention, and I'd be very happy to take a few questions.
questions?
Has your research indicated what percentage of folks in foreclosure misstated their income when they applied for the mortgage?
I don't think I'm not aware that we looked specifically at that question. I mean, clearly during the subprime mortgage boom, there was a lot of misstatement of income. In fact, there were a lot of loans that were made with no documentation of income required. So it's clear that was a problem contributing to the weakness in housing and the collapse in the subprime mortgage market. I think the problems that we have today, though, and this is one thing I wanted to stress in my remarks, go beyond that, because we're really now in a situation where people who had reasonable income, had reasonable credit scores, who did have reasonable down payments, are coming under stress because of two factors: decline in home prices, which has caused their homes to be worth less than their mortgages, and the fact that the employment market is still not very healthy. So that's really, I think it's a big change today, the problem that we're facing relative to a couple years ago.
We have a question.
Yes, over here.
Yes. There have been instances of strong
We have a mic.
even strengthening rental markets. How does that fit with your analysis on the home markets going forward?
Well, I think the rental markets are strong in part because some people who would normally be buying homes can't afford to buy homes. So we've had a shift in the relative demand for home purchase versus rent. And obviously it takes it takes some time for the rental market to respond to that increased demand. And so that in the interim, rental prices are going up. Also, we've had some problems in the sense that we're probably not getting the real estate owned out back into the rental market fast enough and efficiently enough. So there's, we're being inefficient in the sense that there are a number of homes that are just sitting vacant, that if we could get those homes occupied, that would take away some of the upward pressure on rents.
We have a question over here.
In your figuring on the cost of foreclosing a mortgage, perhaps you should figure out how much it costs you when you get the people out and the house becomes a copper mine for people to come in and strip out the copper and the fixtures.
Well, I think the one thing that our analysis very definitely stresses is there's a huge dead weight loss as you go from the performing mortgages to the house actually going into foreclosure. And really, that's what we're really talking about, is how can we implement programs and procedures that can reduce the number of homes that encounter that huge debt weight loss. There's probably a 30–40% loss in value as the home goes from current on its mortgages and goes through the foreclosure process. That's just a dead weight loss to society. And so the challenge for us is to design programs that, one, try to mitigate how high that dead weight loss is by improving the foreclosure process, and two, by minimizing the number of homes that actually go into that foreclosure process. And by doing that, we can reduce the cost to society of the housing problems that we face.
We have a question here.
Hi. Have you looked at, there are supposed to be about 1 million homes which flood very often. What about thinking that way, that if you remove those 1 million homes which get flooded, and of course FEMA pays for them, and you can guess I'm from Wayne, so I know about it. So.
I didn't understand the question.
There's supposed to be about 1 million homes which flood. They're in flood zones.
Yes. I'm very, very aware of that. With Hurricane Irene, my home, which I thought was not in a flood zone, turned out to be in a flood zone. I think there are some interesting issues in terms of land use and flood zones. That's not something that we've looked at, but I think it is an interesting issue about should homes continue to be built in areas that are vulnerable to flooding. I think that's a reasonable question, but I think that's sort of a separate issue from the housing issues that I'm trying to address today.
I think we have time for 2 more questions.
We have a question here.
Thank you. So your staff has done a lot of work and research around this, and you've come up with some potential remedies. If you were to implement some of the remedies, what's your best guess for how long this market would take to recover to back to a normalized level, or is this something that's going to be like a Japan phenomena?
Well, I think I think that a lot of the adjustment has already happened in the sense that we've already had the big adjustment in prices so that homes no longer look overvalued. We've also had the big adjustment in housing activity in terms of actual new housing starts. So it doesn't look like there's, if the labor market were to continue to improve and household formation rates were to pick up, I think that the excess supply of housing that we see in the U.S. is not that large at this point. So I think that you could actually see a turnaround in the housing market relatively quickly, within a year or two. What I'd like to do, though, is make that sooner rather than later, and that's why I think some of these programs would be helpful in that regard.
Okay, this will be the last question.
Well, this is one I would like to think for all of the bankers that are in the room. Really appreciate, Bill, the dissection of our chaos that we're in and the recapitulation and rebuilding of where we can go from here to there. Now, some of us, not all of us, some of us have interceptors. We call them regulators. Are they in step with you? Because if they're not, that's continued chaos for us.
No, I think it's a fair point. It's very important that that the needle of the supervisory and regulatory process doesn't swing from being too lax to too tight, and we're very cognizant of that risk, and so we tell our examiners that you have to look. You don't want to overreact looking in the rearview mirror. You should be focused on looking at the road going forward. So that's certainly a risk. I think I think we see this in a number of areas, though. I don't think it's just the regulatory process. I think, as I mentioned in my remarks, the appraisal process seems to be another example where the needle has swung. Probably was too lax back in 2004, 2005. Now it's probably too restrictive in 2011, 2012. So it's something that we're definitely aware of, and we want to make sure that we're not part of the problem in terms of digging out of this housing mess. Thank you very much.
Thank you very much, Bill.